You would think that after borrowing $30 trillion, all of the cities and towns would look like shiny, gleaming utopias. Libraries and schools that make architects blush, high-speed rail networks connecting every major city, state-of-the-art airports, brand new bridges and roads, trees-lined bike paths in every city. Instead, we have growing homeless encampments, rising crime, crumbling infrastructure, and highest national debt in the world. We are sure you have guessed it by now. The country is, in fact, the United States of America. Keep watching as we discuss America's debt crisis unfolding in real time. Don't forget to like, share, and subscribe. An important factor is who the country owes money to. If the country owes money to entities outside of the country, a high debt to GDP ratio is potentially dangerous, as their creditors will be unlikely to make concessions should the country hit hard times. However, if most of the debt is owed to domestic institutions, the debt is much more manageable, since an economic downturn in the country would hurt the lenders as well. So, they have an incentive to keep the country solvent and make concessions. That is how Japan is able to maintain such a high debt to GDP. Its creditors are almost all Japanese entities, and so they won't act in a way that undermines the Japanese economy. The government tackles its money matters by issuing bonds, essentially borrowing money to handle the national deficit. For the past 2 decades, it's been consistently running deficits, piling up quite a hefty debt. The bond market suffered a significant meltdown in 2022. Bonds are generally thought to be the boring, relatively safe part of an investment portfolio. They have historically been a shock absorber, helping buoy portfolios when stocks plunge. But that relationship broke last year, and bonds were anything but boring. The implosion is largely a function of the US Federal Reserve aggressively raising interest rates to fight inflation, which peaked in June at its highest rate since the early 1980s and arose from an amalgam of pandemic-era shocks. Bond prices moved opposite interest rates. As interest rates rise, bond prices fall. In basic terms, that's because the value of a bond you hold now will fall as new bonds are issued at higher interest rates. Those new bonds deliver bigger interest rate payments courtesy of their higher yield, making existing bonds less valuable, thereby reducing the price your current bond commands and dampening investment returns. The recent increase in gold prices was initially associated with anticipation of a rate cut by the US Federal Reserve. Central banks, billionaires, are actively involved in buying gold. China takes the lead as the primary purchaser among central banks, while other emerging markets, like Russia, are also boosting their reserves as part of a diversification strategy. The global trend favors assets like gold and Bitcoin to hedge against fiat currency risks. Central banks, notably in the third quarter, increased reserves, with a record gold price of $2,114 in December, driven by geopolitical tensions. A survey shows 24% of them plan to boost reserves in the next 12 months, reflecting growing pessimism about the US dollar. Bitcoin surged to $44,000, with speculation of further increase to $48,000. Nations like China, Poland, and Singapore lead in diversifying assets, contributing to increased demand. Saudi Arabia's interest in a gold and copper deposit is noteworthy. Exploring precious metals is seen as a prudent investment amid global uncertainties, especially in the election year of 2024. So, as the financial stage is set, central banks, billionaires, and the global audience eagerly await the next act, wondering if gold and Bitcoin will continue their spellbinding performance, casting a captivating glow on the world of wealth. Ken Conrad, who is a senior fellow of the Bipartisan Policy Center, voiced concerns about the US deficit, characterizing the situation as a defining moment, with fiscal affairs posing economic and national security risks. The United States is facing a predicament characterized by immediate hurdles such as escalating real interest rates, imbalances in bond supply and demand, and uncertainties surrounding government debt. Moreover, the bond yield is expected to hover around 3 to 3.5%. The situation is additionally complicated by political, social, and foreign demand factors. Various revenue options are suggested, including reevaluating tax breaks, considering a carbon tax, and reassessing how capital income is taxed. The world is witnessing financial enigma. where power and debt are challenging conventional notions of strength and fiscal resilience. The United States debt, standing at $33 trillion, making up 122% of the country's GDP, with an additional $500 billion added to the deficit recently, it raises concerns about the long-running crisis. The statutory limit on it has been repeatedly raised, with the last increase to $31.38 trillion in 2021. Current statistics show national debt per capita at $92,528, which is a crucial indicator. Its ceiling was reached in January 2023. Its foreign holders include Japan, with $1.1 trillion in treasury securities. The forecast suggests a gross federal public figure of $51.99 trillion in 2033 and a projected budget deficit of $1.38 trillion in 2028. The United States holds the world's largest national debt in terms of the dollar amount, coupled with the distinction of having the largest economy globally. This results in a debt to gross domestic ratio of approximately 128.13%, and above 100% is viewed as problematic. The government consistently spends more than it earns, with no budget surplus since 2001. Notably, the primary countries to which the US owes the most are Japan and China, often considered its forecast economic competitor. Congress has authorized trillions of dollars in spending over the last decade, causing the United States debt to nearly triple since 2009. Over that period, the Treasury Department's ability to borrow money to make payments on that debt has repeatedly run into a congressional-mandated limit on borrowing, known as the debt ceiling. Efforts to raise or abolish the ceiling have become a topic of hot debate among policymakers. Some lawmakers who decry government debt have used negotiations on altering the limit to try to force spending cuts. The congressional brinkmanship over the issue has increasingly led to disruption, including government shutdowns and the specter of default that has threatened to push the economy into crisis. President Joe Biden and a Republican-controlled House of Representatives squared off again over the issue in 2023, leading economists to warn of catastrophic consequences if the Treasury Department could no longer pay the nation's debts. There are global economic shifts, citing talks between China and Brazil about moving away from the dollar, and OPEC's efforts to encourage non-dollar payment for oil. Echoes of alternative currency are strong, but the prospect of the Chinese yuan taking the place is deemed impractical. Middle-class US citizens are also in the mix, with apprehensions rising as the collective credit card debt of Americans surpasses $1 trillion, accompanied by an average interest rate exceeding 22% and its retail rates nearing 29%. This is attributed to the Federal Reserve's recent rate hikes. The household budgets are strained due to elevated borrowing costs, resulting in a rise in delinquencies. The surge is further fueled by the opening of over 70 million new accounts since 2019. The interest rates on them have escalated to levels surpassing 33%, especially for subprime borrowers. A strategic approach is required to manage, including the utilization of 0% balance transfer cards and prioritizing the repayment of higher interest credit card balances. America is also facing a decline in annual revenue, dropping from around $5 trillion the previous year to about $4.4 trillion, with a $450 billion reduction in personal income taxes for 2023 compared to the prior year. Government debt is important for funding public services and dealing with financial crisis. If it is managed well, then it can help economic growth and infrastructure. But excess causes problems like repayment difficulties, reduced investor confidence, affects a country's budget, impacting spending on important services like healthcare and education. Balancing it is crucial, requiring effective management and responsible policies for development. Comment down below on what you think, and if you liked this video, please consider liking, subscribing, and sharing the video. Thanks for watching, and we'll see you in the next one.